IPO day one, chaos. Day two, usually just a dud sideways. But day three, that's when the smart traders show up. So in this video, I'm going to break down how I trade IPOs, particularly focusing on the third day. And that's the exact pattern I look for, why it works, and how to spot it before the crowd. I mean, that's the best part about this pattern. So if you've been burned chasing the hype of IPOs on day one, many people fall into that trap. This is the setup and that ultimately brings structure to all of that wild volatility and madness. So let's get into it. Why IPO trading is different. I mean, flat out, you have no chart history, okay? If you've been following the channel for a while, hopefully you have. I mean, you know one of the big things we do to make decisions is using multiple time frames, short term, mid-term, long term. Well, what do you do when a stock is never traded before 5 minutes ago, okay? You're lacking that information. And that's one of the big reasons that day one is so unpredictable. I mean, you have no historical information to base your trading off of. The other thing, halts, okay? I'm sure many of you have been there. Stock starts trading, let's say it's a successful oversubscribed IPO, halts up big. Then you're sitting there waiting, maybe you're in it, maybe you're not, halts down big. You're like, oh, it's a failed IPO. Then a few minutes later, halts up big. Oh, maybe it's a successful IPO. So there's just so much of that volatility that can just really create panic buying, panic selling, which is the last thing we want. So my recommendation, unless you're experienced, just let things play out on day one. I know it's tempting. You see some of these, listen, the reason I'm doing this video, we're in a very hot IPO market. I mean, we've seen stocks IPO and open up 100% above where they were expected to open and then continue higher and continue higher. So it's like, I know it's easy to get tricked in, but because of the volatility and the madness and the halts, really hard if you're new on day one. So I would beg any of you, if you haven't, if you're not consistently profitable, been trading for a while, just let day one play out. If it goes up big, so be it. We're going to talk about the way to approach it. If it falls apart, obviously you want to avoid it anyway. But that being said, we avoid day one. Let's assume you're a newer trader. Day two is almost always the same thing. Nothing. Like you've got that madness on day one, then day two, stock opens up and typically just kind of chops around. Maybe goes up a few percent, goes down a few percent. It goes, and it just slows out because of all of the madness from the previous day. So there really isn't a trading opportunity there. I mean, think about it. If you're looking to day trade for, big gains, you can't do that on a 2 to 3 or 4 or 5% move. And the other thing, what happens is you just buy it and nothing happens, locks up your buying power and you miss other opportunities. So day two is just for observation. And I'm not saying you got to watch this stock all day long. Just kind of check in on the previous day's big IPO. Maybe, in the morning, okay, what's it doing? Take a peek at it on your phone at lunch. Okay, what's it doing? What we're looking for, and this is key, is exactly what I explained. That kind of sideways price action, but it maintains the majority of day one gains. Now, if it's one of the few, and this does happen, that say sells off on day two, well, that's just one we forget about. We don't care about. What we're specifically looking for is that consolidation type price action, which tells us that there's no big sellers, nobody's dumping it from day one, and there's at least enough buyer interest to support the stock. Now, let's say we have one of those scenarios. Crazy madness on day one, you avoided it. Day two held up, consolidated, retained almost all of its gains from day one. Now, day three, that's when the real pattern starts to emerge. Now, you may have heard of the day three surge pattern. We use this one all the time in penny stocks, momentum stocks that ran big, then kind of chopped around on day two, and then we trade the day one high. Very similar pattern. I mean, if you think about it, when IPOs first start trading, there's a term you may have heard me use. It's like they trade like a penny stock. Like sometimes mid-cap, large-cap stocks will trade like a penny stock. I mean, we'll see that with Tesla sometimes. I mean, when Elon's doing some crazy stuff or announces robots or something, it makes big moves. Most days, single digit percent, no real day trade opportunity. But occasionally you'll see that huge range of action, which as short-term traders, bigger the range, bigger the volatility, more opportunity to make money. So that's kind of what we're doing, is we're using a penny stock pattern here with a legitimate stock that is recently IPO'd. Let's fast forward into day 3. So by now they've shook out all the weak hands, all the people just speculating on the short term. And then the way we're going to approach that pattern is, and let me draw it out for you. So we've got day 1. Think of day 1 as just madness, okay? Halts, actually I'll denote that in red. Halt down, halt up, just kind of all over the place. Now, let me show you what we want. Then let's segue into day 2. So let's imagine that stock is doing that price action I talk about. The volatility, the range tightens up, coils up, and if you notice, it's still within range of the high from day 1. So what we're looking at, what we're keying off, is that high of day from day 1. Now, couple small attributes I want you to add to that. I recommend, and I do, using the 5-minute candle body. Okay? Now, a lot of you guys have been around, you know how much I highly recommend using 5-minute candles. Now, you're always free to adapt in any way you want. You can do that. But what we're looking for is a snapshot. Like, I don't really care about some big wick that spikes up here for 10 seconds, okay? Or vice versa, that, let's go to this candle, that big 10-second down wick. What I'm trying to look for is a stability period. And by using that 5-minute candle high from day 1, so I can just kind of draw that line across, that's that hard line. Now we come into day 2, we've got the picture perfect way to approach the day 3 surge setup on this example, that stock that is consolidated, volatility is decreased, and then built that base where we can actually risk off of. Like, it's always important, and something you'll notice that's a unifying theme through all of these videos that I do is we're always thinking about our downside. Like, one thing that I do and I teach and beg all of you to do is before you enter a trade, you're always thinking about your downside. We can never control how much we can make, but we can always control how much we lose. Now, where traders screw up is they simply don't think about the downside. They only think about the upside. What if this stock goes from 10 to 15? What if this stock goes from 10 to 20? They never, ever think about what if this stock goes from 10 to 9, 10 to 8, 10 to 5. So by having that day 2 consolidation area, and actually I'll switch back to red, we now have a risk level. So we're gonna think about our stop before we even enter the trade. Now that might sound counterintuitive, but guess what? 90% of traders fail. They never do this type of stuff. I'm always thinking about my downside. What's my risk? Think about, I don't care what strategy you're trading. You're a risk manager. You're putting money into the markets and you have to manage that risk, because if you don't, all that money is going to be gone. So we're always thinking about what our downside is, and we can use that consolidation zone for the point where the market has told us we were wrong. The market is always right, my friends. You can argue with the market, you can yell at the market, you can cry at the market. It's always right. You can never, it's an immovable force. All you can do is respect the market's power and act accordingly. So you can say, oh, this stock should bounce. Oh, this stock should do this. None of that matters. The market's always right. The price action's always right. Don't justify, don't make excuses, don't cry, don't yell, etc. It's right. So now, using that breakdown area, we have that stop loss set. And then what we're keying off of is that break of the day 1 5-minute candle body high. So now, by doing it this way, We avoid the madness of day one, we avoid the sideways chop of day two, and we're able to write a trade plan. So now we have an entry. And, I always think of a trade plan as an equation, okay? A equals stop, B equals entry, C equals profit target. Now, what I like to do when we do risk management, and I've done a lot of videos, I'll save that for this video, is we like to extrapolate our price targets based on the range of the stock as well as how much we're risking. So we always like to target, can't guarantee anything, target 3-to-1 risk to reward. So in this instance, we've got an entry, we've got a stop, and we've got that profit target. And you will find if you start using the day three surge and avoiding the madness, I know it's tempting. On day one. Avoiding the madness of day one, you're not going to get chopped apart. Avoiding the sidewaysness where there's no opportunity anyway on day two. And then when you can get that follow through continuation move on day three, your risk to reward goes up, your potential goes up, and you're able to actually write a trade plan because now we have a couple days of chart history. Remember where I started. If we have no chart history, how do we trade it? Doing this, we've been able to build the chart and have it guide us through the trade. IPO trading isn't about hype. I mean, people fall for the hype. That's why so many people get suckered into these IPOs. It's all about timing. Timing is what matters. And day three is where the highest reliable pattern shows up and the risk makes the most sense. So stick to the setup, respect your stops, and don't chase, don't be impulsive.